Well, hello there, my sleepy friends. Get comfortable now. We're going to talk about something that once shook the whole world. Not an earthquake, not a storm, but something quieter. Numbers, promises, trust, and how all of that broke down. This is the story of the 2008 financial crisis. Let's start at the beginning. It's the early 2000s. Life feels full of possibility. Interest rates are low. Banks have money to lend. Everyone wants the same shiny dream, a house of their own, something solid, something safe. Banks say, sure, we can help with that, even if you don't have much savings. Even if your job isn't steady, they still say yes. These loans are called mortgages, and soon they're being handed out like candy. Some of these mortgages are good, some are risky. The risky ones get a special name, subprime loans. Subprime means not the best, but there was a lot of profit to be made. And profit, you see, can make people forget risk. Now imagine this. A banker gathers up thousands of these mortgages, good ones, bad ones, all mixed together, and ties them up in a neat little bundle. That bundle gets a fancy name, mortgage-backed security. Other investors buy these bundles, believing they're safe. Why? Because trusted rating agencies, the ones who were supposed to judge risk, gave them top marks, a AA, the best. It was as if someone labeled a banana diamond, and everyone just nodded. Banks sell, investors buy, money flows, the market hums, the prices of homes climb higher and higher. It feels unstoppable. But housing prices can't rise forever. They never do. Slowly, life catches up. People who took out risky loans can't pay them back. One house goes into foreclosure, then dozens, then hundreds. The mortgage bundles start losing value. Investors get nervous. Banks start looking at each other and wondering, wait, how many of your loans are bad? Trust cracks, credit freezes, money stops moving. In 2008, the illusion shattered. Lehman Brothers, once a titan, fell. In its wake, panic. Banks clutched their cash. Credit markets froze. The stock market plunged. Everywhere, people watched the same headlines, glowing on phones and televisions. As savings evaporated before their eyes, factories slowed, businesses shuttered, millions lost jobs, homes, and hope. A global economy built on confidence suddenly forgot how to trust. In the fall of 2008, the heartbeat of the financial system nearly stopped. Banks froze, credit vanished, fear spread faster than facts. Inside the crisis, one institution became the steady hand, the Federal Reserve. The Fed slashed interest rates to nearly zero. It pumped billions, then trillions into the market, not to make anyone rich, but simply to keep the blood flowing. Programs with cryptic names, TAF, TALF, QE, all designed to restore trust. It was triage on a global scale, an economy on life support, and slowly, the patient began to breathe again. The Federal Reserve could lend, but real healing needed more than liquidity. It needed confidence. In Washington, a controversial rescue plan emerged, the Troubled Asset Relief Program, or TARP. The U.S. Treasury poured hundreds of billions into stumbling banks, insurance firms, and automakers. The message was simple. We can't let everyone fail at once. People were furious. It felt unfair, but without it, the economy might have entered a dark age. Sometimes survival looks like surrender. Across the ocean, other nations scrambled. Europe launched emergency funds to save its own banks. China unleashed a massive stimulus. Roads, railways, entire new cities built almost overnight. Every central bank on earth began cutting rates, pouring oxygen into the same fire. The world realized just how intertwined it had become. Finance was no longer national, it was planetary. And when one heart faltered, everywhere felt the ache. While the headlines told tales of bailouts and billions, the streets told quieter stories. Families left homes behind, their lawns uncut, their mail uncollected. Entire neighborhoods became ghosts of prosperity. Jobs vanished, 401ks shrank. Every paycheck felt temporary. In coffee shops and living rooms, people whispered the same phrase, "What happens now?" The economy was recovering on paper, but in kitchens and classrooms, fear lingered. Beneath the surface, economists and bankers rewrote the rules of stability. They created stress tests for large banks, imaginary storms to see if a system could weather another collapse. They mapped the arteries of credit, tracing where risk hid. They built new tools, new safeguards, as if patching a hull mid-voyage. It wasn't glamorous. There were no parades for the accountants, but slowly, quietly, order returned. Recovery didn't heal resentment. People watched Wall Street bonuses return while foreclosure signs still dotted the suburbs. In 2011, protesters gathered under rain-darkened tarps in a small Manhattan park. Occupy Wall Street, a movement born of disillusionment. Their chant was simple, "We are the 99%. It echoed across cities around the world, a reminder that statistics are never the same as fairness. The financial system had survived, but its reputation had not. Politicians answered the outrage with policy. The Dodd-Frank Act became the new backbone of regulation. Banks had to carry thicker cushions of capital, trade less recklessly, and submit to deeper oversight. The wild frontier of finance became fenced and patrolled. Wall Street grumbled. Washington watched. The public hoped it wasn't just theater. For the first time in decades, the invisible hand of the market found itself wearing a seatbelt. Years passed. The stock market climbed again. Housing prices rose. People began buying, hiring, building, living. Confidence crept back like spring thawing winter ground. Yet something had changed. The sparkle was gone. The next generation viewed money differently. It saved more, borrowed less, asked harder questions. The recovery was not just economic, but psychological. Out of the ruins, new ideas quietly bloomed. Digital money, Bitcoin, once dismissed as a curious experiment, found believers who distrusted traditional banks. Startups promised disruption. Technology claimed it could make systems transparent again. The sharing economy, the gig economy, new forms of earning, born in the shadow of old systems that had cracked. Necessity turned to invention. In the ashes of crisis, innovation slept with one eye open. The crash didn't just change markets, it changed societies. Years of slow recovery bred skepticism of governments, of experts, of truth itself. Populist movements rose from both ends of the spectrum. Blame shifted from bankers to bureaucrats to neighbors. Elections across the 2000s carried echoes of 2008's frustration. People wanted simplicity in a complicated world. The aftershock of lost trust reshaped entire decades of democracy. 15 years on, the charts have healed. but the memory still hums quietly beneath every forecast. When new markets wobble, cryptocurrencies, real estate, technology bubbles, voices return to that old refrain. Could this be another 2008? The crisis lives on as a compass, a warning in every boardroom, a ghost in every policy debate. Its greatest lesson wasn't about greed or regulation. It was about fragility, the delicate balance between confidence and collapse. The system survived. So did we. From the Federal Reserve's frantic midnight meetings to the hum of calm markets today, the story has come full circle. In every number, every deal, there's still a pulse, the faint echo of the moment the world almost stopped. And now, as night settles over glowing city towers, the markets sleep again. History exhales, softly, steadily, a new day waits.